Let's start out today's show, as always, with a little money chat.
Money.
Today I'm going to talk about mortgage insurance and mortgage insurance removal, how you do it, when you can do it, and what loans you can do that with. Now, I mentioned in an earlier show that President signed legislation that renews the tax deductibility of mortgage insurance premium, MIP premiums for qualified homeowners through 2016. So that was great news to be able to save some money on your taxes. The deduction is available for homeowners with adjusted gross income below $100,000 at the 100% of the premium. Now, for homeowners with adjusted gross income from $100,001 to $110,000, deductions are phased out at 10% increments for each additional $1,000 of adjusted gross in household income. Now, today I wanted to talk about the removal process for mortgage insurance, MI or private mortgage insurance, PMI. Now, it depends on the loan and whether you can remove mortgage insurance or not. Mortgage insurance premium, MIP, is attached to FHA or HUD financing and is required for the life of the loan. So there's no opportunities to be able to remove mortgage insurance if you're on an FHA loan unless you refinance into conventional financing. Now, private mortgage insurance, PMI, is for conventional financing and can be removed. The Homeowners Protection Act law governs when a mortgage lender can and must remove private mortgage insurance for a home loan. Now, lender's mortgage insurance, also known as private mortgage insurance or PMI, in the United States is an insurance payable to the lender or trustee for a pool of securities that may be required when taking out a mortgage loan. It is insurance to offset losses in case the consumer, you as the homeowner, is not able to repay the loan and the lender is not able to recover its cost after foreclosure and the sale of the mortgage property. Now, PMI is required on conventional loans with less than a 20% down payment. Automatic PMI termination. Once your loan has a value based on a loan to value based on the original price paid for the home, at 78% of the PMI will automatically terminate if your loan payments are up to date. Now, requested PMI removal. You can request removal of PMI when the loan balance reaches 80% of the original home's value when the loan was initially taken out. A PMI disclosure will be part of the disclosure package and lists the date when your loan will hit that 80% mark. Now, extra principal payments during this time can shorten the time to reach that 80%. To have the PMI removed, you must be current on your mortgage payments and request the PMI removal in writing. Now, the lender may require you to prove that you do not secure or have any second loans against the property, and you may have to pay for an appraisal to show the home value has not decreased. Doesn't matter if it's increased because we haven't gotten to that part yet, but this is an extra 2% in the loan to value from 80% to the 78% that we talked about earlier when it will automatically drop off. The lender will remove it. Now, if you wait until the 78%, that extra 2% loan to value, it can be a substantial amount of money that you're paying additional in PMI because you did not make note or make reference to that 80% and when that date hits. So you definitely want to mark your calendar on a $100,000 loan with an estimated 0.78% calculation for the cost of mortgage insurance. This would be an additional $65 a month that you'd be paying until you hit that 80%. Now, alternative termination criteria. The Homeowners Protection Act dictates that the PMI can stay on the loan for no longer than 1/2 of the term of the loan. So even if the loan to value is greater than 78%, when half of the term has passed, the lender must remove the mortgage insurance. This is final termination of the PMI, and it might occur with mortgage terms that are included in an interest-only payment when the loan balance is not reduced by the actual monthly payments. Now, let's talk about the exciting thing is the request of early PMI removal. You can request early removal of PMI when the loan balance reaches 80% of the home's current market value. In addition, you must have a minimum history of making payments on the loan. With most lenders, this is a minimum 36 months, but in some cases, it might be as low as 24 months, never lower than that. So you're going to see between 24 to 36 months that you can go in for early removal. To have the PMI removed, you must again be in writing and have that 20% equity position on the current market value. The lender may require to prove again that you don't have any second mortgages against the home, and you're definitely going to have to pay for an appraisal of $500-$600 to show and support that the 80% loan to value has been met based on the current market value. There are ways to avoid paying PMI altogether with less than 20% down. Those of you who have listened to my show on a regular basis, I've talked about the buyout or the single premium mortgage insurance, which is my favorite if you plan on keeping your property. Now, here's the ways to get out of paying the monthly mortgage insurance. Lender paid PMI. This is where you're going to take a higher interest rate for the life of the loan. It's not my favorite option unless you're going to keep the property very short term, maybe less than a couple years. Now, the single premium, also known as a buyout, which is my favorite, this is an upfront fee to avoid paying the monthly PMI. Now, this is a great option if you plan on keeping your loan for longer than that 24 to 36 months, depending on how long the minimum requirement is before you reach that 20% equity position. So the numbers don't lie. It's really easy to determine what's best for you. Run the numbers on all of your options. Again, as a reminder, make sure that your mortgage consultant is shopping all the mortgage insurance companies because, yes, they do price differently depending on different qualifying factors. And coming up next in the Money Hour, new construction is on the rise and in high demand. Today, we're going to discuss the new construction trends and opportunities for the next real estate purchase and how it might benefit you looking at new construction properties. I have Liz Johnson with the Liz Johnson Group at Keller Williams Realty Puyallup right here on 1150 AM KKNW after this short break.